Hello and welcome to the Wealthmind Podcast, the show that talks about all things wealth and aims to give insights and perspectives to support us all on our wealth creation journey. I am your host, Katie Robertson, and today I'm joined by George Lucaci, who is the Global Head of Distribution at FolioBeyond. In today's episode, we'll be talking about wealth creation and investments. George shares fascinating perspectives from his experience in supporting his clients with their portfolio management and emphasizes the importance of diversification. Thanks for listening and thanks for joining us, George.
Thank you very much. Thank you for having me.
So we start these discussions with people sharing a bit about their background and their journey that led them into the role that we have today. So it'd be great if you could share with us and anything that you can share with the listeners on lessons that you've learned along the way.
Sure. Thank you very much for having me. Certainly, it goes back a while. My career, I started out as a proprietary foreign exchange trader at Citibank, where that really doesn't exist anymore. The proprietary trading, for numerous reasons, mostly regulatory, but that was a real lesson in understanding the capital markets and the corporate world as far as fund flows are concerned globally. From that, they took a bunch of us from the FX world and they moved us into what at that time was a new world, the mortgage-backed securities world and securitization. So at Citibank, we actually developed one of the first CMOs that we distributed within the United States and finally into Japan as well. So the securitization started in Citibank, so did foreign exchange, proprietary trading. And then I moved over to be head of the product and sales group nationally at Merrill Lynch. From there, I moved to head of fixed income sales at Nomura Securities for a number of years. And then I worked as a risk manager for a large macro hedge fund in the 90s and moved on to become one of the partners in a group called hedgefund.net, which was actually the first digital platform for hedge funds. And we did that for about 10 years. And then we sold the company to NASDAQ. Hedgefund.net was sold to NASDAQ. I moved on to becoming a partner in Mercury Capital Advisors, which is one of the larger private equity placement agents. And that was sold as well to a Bahraini company. And then I came together with some of my old fixed income friends from many, many years ago, from decades. And because most of my career ended up being fixed income bonds, did very little in equities. So most of it was alternatives, hedge funds, private equity within the fixed income world. And the company FolioBeyond, which you mentioned before, was started in 2017. And in 2020, we felt very uncomfortable with where we thought interest rates were going. We felt that this was the beginning of a secular bear market in bonds. So we launched in October 1st, 2021, an ETF called RISR, RISR, that is right now about $200 million and has had about 16% average annualized return over the last 4 years. And it's getting a great deal of attention right now because of its diversification qualities. It's not correlated to equities, nothing in the fixed income world, nothing in high yield. So we're a non-correlator, a high diversifier. And I think at this point in the market, people are a little bit not as optimistic as they were. They're seeing a little bit more volatility. They're not as convinced that the equity markets can continue to go up. So we have gotten a lot more attention with this ETF. We also launched another ETF called FIXP, FIXP, which is a ETF that basically is a substitute for a fixed income allocation. And that is still in its early stages, but we expect that to grow over the next couple of years as well. So that's where we are. We're a fixed income shop. It's a boutique shop. Maybe total under management, including separately managed accounts, is maybe $210, $215 million.
Hey, fantastic. I have a sort of portfolio of ETFs and I think they're great products. And how you use sort of some language there around fixed income and allocation, and how could you expand on them as to how people should think about that when they're thinking about pulling their whole portfolio together?
Yeah. So that's a good question. I think the traditional portfolio 60-40 is something that has really gone out the window. And if you ask me what's changed as far as the wealth management business, it's the idea of the wealth management world moving closer to the institutional world, or the mentality of the institutional world. We see that happening. And that is manifested through allocation in alternatives. Now, alternatives is a very broad phrase, and it could be gold, it could be short ETFs against the equity market. But what we're seeing is that the allocations have become much more original. People are doing more research in the ETFs, as the ETF world is truly growing because of the liquidity features it has and the ease of buying and selling them. Now, I don't have to tell you that we've had a start of a new technology wave, especially as one as profound as AI that's occurring right now. And there's, of course, a lot of optimism and excitement and optimism. And, if you look at portfolios now, despite the fact that people want to stay diverse, they're highly weighted on the tech sector. And I think that's something they have to be very different. They have to be very careful about. And now over the last few months, there's been a lot of talk about an AI bubble's going to last forever. I don't have to tell you that. And it's also driven by a high profile individual called Michael Burry, who is critical of what he calls circular financing and questionable accounting in a lot of these tech companies. Now, I don't know if that's true or not. Michael Burry does have a pretty great track record and famously bet against the housing market in 2000.
He certainly did, yeah.
So I think he's taken large short positions in NVIDIA and Palantir and uses the word bubble. It's something that we don't comment on. We just see it. We try to learn from what's going on in the equity market. But we're getting calls from equity players who, in fact, saying, I see that you're not correlated to equities. Maybe this isn't a bad hedge. So again, they realize they're maybe overweighted in the technology world. They believe in diversification. They want alternatives. And that's kind of how evolution is. There's a lot of different sectors of evolution where you're talking about commission-based to fee-based, but we can talk about that at some point as well.
Yeah, fascinating. There is a lot of discussion around AI just now, and I think there are a lot of people taking different bets. I do think as a whole, it's going to completely transform the way that we operate. And I was reading about some work or collaboration that you did with the MIT AI lab. Is there more you can share on that? And
yes, that was a lot of fun. We had a lot of fun.
I imagine it would be, yeah.
And it was very early in the AI world, dealing with the MIT people who were brilliant and wonderful, and it was a lot of fun working with them. But it was large language. It was a massive amount of data that they sift through. It was a whole host of early AI thinking that helped us not to predict the markets, but just to deal with all the data out there. That's about as far as it went. But they were always coming up with different models that we use at this macro hedge fund that dealt in everything from foreign exchange to mortgage-backed securities. Again, mostly away from the equity markets. So yes, they had an MIT AI lab in the 90s, if not before. And there's some very famous people who came out of it. I don't know what they're doing now, because it seems like, the ChatGPTs of the world have taken over, NVIDIAs and Palantirs have taken over the AI world. And there's maybe 4 or 5 players that have done that. And I'm sure that MIT had its influence there, but they were early and they were committed to staying in the market. And I can't believe it's been 25 years since we were talking about AI. And now it looks, and it's being discussed like it's brand new. It's not brand new. It's been around for a long time. It's just evolving.
Yeah, I think that's a really interesting point, that a lot of people do think it is new, but I've worked with some great people who have been at MIT and have PhDs in AI, and it has been around for a long time. And I think the likes of ChatGPT, just that sort of user interface, make it a lot easier to interact with. But yeah, it's been around for a long time. There's a lot of organizations have been using it for a long time. And as you say, it's key to having your data organized is absolutely key to getting the maximum.
It's key for that. It's key for doing research and asking questions about certain points in history. And not that, again, it's not always correct, whether it's ChatGPT or Claude or whatever, they do make some mistakes. When we asked about FolioBeyond one time, just as a bit of fun, they told us that we were purchased in 2019 by Macquarie Bank in Australia. And I said, where did they possibly get that? We were never purchased. So it was just out of the blue. So you have to be careful when you use it. And if, for example, what was the average 10-year note over the last 30 years, it probably comes up with 535. But then again, you take away the vocal years and you take off away the reserve, and it's more like 465. So there's things that you have to continue to input into AI to make sure you're getting the right answer. Because we reactively answer your question exactly the way you ask it. Now, on a more literal sense, if you're writing something, you can actually very easily change the tone of how you're writing something. Make this more sarcastic, make this more commercial, and it's very good at doing that.
Yeah, I found it'd be interesting to see your perspective and your team's perspective. I found it very good from a language point of view, with where you put numbers and numeracy into different outcomes you're looking for. I think that's where we've had to be, prompting has to be very specific, whereas the language side is seems to be a lot easier, and I'm sure the numeracy side is progressing fast. But yeah, that's been my experience to date. Of the language side is easier.
Yeah.
But for your models and that you're running with your predictions, how are you finding that space evolving?
Yeah, we're beginning to look at these kind of models, maybe for the equity markets, which we're not involved in yet. So we're just doing a little bit of research. It's interesting how COVID accelerated this technology. I'm not sure that many people talk about it because we had to have forced digital adoption, didn't we? I didn't go see you at your office. I had to all of a sudden have the Zoom meetings. Or e-signatures are old, but that's the way they wanted it done. So you're going to hire somebody, you're going to onboard them digitally instead of bringing them into the HR office. So it did accelerate a lot of the technology, I think.
One of the few benefits of that time in our lives.
Well, it did. Think about that. It really did. That amount of time, if you were in any sense a diligent professional, that 1 hour and a half that you use each morning to commute, or that 1 hour and a half that you were using it very usefully. So effectively, people criticize the remoteness of the remote attendance, but if you were an industrial professional, you use that time for your company in a productive way. Now, I know the camaraderie is important. If you can come in 2 days a week, maybe 3, I think it works. I think it works to work remotely. And some of the more important companies out there, I think, do that. Some of the more like mainstream commercial banks are very much against it. And my opinion is they're against it because they own so much real estate. So
I would agree with you. I think certainly I've seen that in New York. Yeah, there's a big focus on some of these very big buildings and some of the developments. And yeah, I would agree with you on that. And I think you have to make the effort to have the human connection, whether that's in the office or Zoom. Zoom has made it very easy for us all. But you have to put the effort in to make sure that you're building those connections and continuing those connections with your colleagues. Just checking in on them sometimes as to how are you doing?
It's good. It's good to check in. I'm on a Zoom call every day, and it works for us. Works for my partners. So there's numerous ways of communicating, and it's not just texting. So yeah, we don't sit across the lunch table and text while not talking to each other. I'm sure you've seen that. It's stunning to me to see young people at a restaurant together, not talking but texting. I'm not that old, but I'd like to talk to somebody if I'm going to a restaurant.
Oh yes, we could talk about that. Yeah, definitely agree. Just thinking about sort of industry trends, and we've touched on AI, we've touched on diversification. Is there anything else that you're seeing just now that is a focus for you when you think forward in terms of across the industry?
There's been a wealth accumulation with the boomer community. I think that's been growing quite a bit. I think there's been a baby boomer concentration. The last number I saw, they have about 53% of the country's wealth, which is pretty high. Millennials own maybe 9 or 10%. So there's been that division, if you will, but there's going to be a transfer of the baby boomers to the millennials as well. That's going to be a massive multi-trillion-dollar transfer. How that's going to come out as far as the millennials investing that money is yet to be determined. But going back to the technology, you said, I can remember, I think you do as well, the robo-advisors didn't really replace humans. In fact, they needed that human touch. I think whether it's the baby boomers and millennials, they wanted the human touch, and they were willing to pay more for human advice than they were robo. So there was an actual need for the human touch. And I think I see that now. You know, people say, I got to go see my clients. We're going to spend some time with them. So it gets down to trust. Now, technology enables advisors to serve more clients, but They're not replacing any advisors. In fact, I think there's going to be a shortage of advisors over the next 10 years.
And what makes you say that?
I think the demographics show that, guys. People are retiring. They're 50s, 60s. And they'll be retiring in the next 10 years. And I'm not sure we get enough people that can actually take the place and get the education that's necessary to replace some of these people who've been in the market 20, 30, 40 years. The other issue that I think is a trend, as we talked briefly before, is alternative investments demand.
Yeah, and that's really quite broad, isn't it?
Very broad. It's everything but equities and bonds. So within the equity world, you can have option adjusted type of trades that you can do. In the fixed income world, you can do negative duration trades. These are all alternatives. And I think that, again, the drivers of these alternatives attempt to deal with volatile equity markets, what is perceived to be, and I agree with this, fixed income yields being too low, and the education that wealth managers are giving their customers to seek uncorrelated returns. And I think that education is getting through to them. Tying it all up, technology is making all of this more accessible to everybody to understand and see. The information there is there. If I was to give a very basic equation at the end of the day, given what we've seen with the fiscal chaos, the executive chaos in our country, the congressional chaos in our country, and the kind of debt is out there, the end result is diversification. And I know that's an old concept, but I think that's what people have to do at this point. And they're not diversified. Believe me, Katie, they're not diversified out there. That has to be occurring on a much faster pace, or people are going to get stuck. If they see the stock market swoon, and again, it could swoon, but I'm not about to bet against the bubbles getting bigger and bigger day by day, week by week, year by year. It can happen. But at some point, when we least expect it, things change dramatically. I think the other issue that was dampened for a long time, for political reasons mostly, was the sustainable investments. And I think that, it was poo-pooed for a lot of reasons. But if you look at the returns, and I don't have those in front of me, they're not bad. They're pretty good. The ESG, sustainable investing, the returns are pretty good. And there was political backlash, but now I think it's going to be mainstream again. And many investors that I've talked to are considering, sustainable investing, or under the rubric of responsible investing, ESG being one of those. They're thinking about it in some form. So for those more aggressive on this, and I don't see a lot of that, but I did 10 years ago, but not now, climate change and clean energy were priorities. That stopped for a while, but I understand, and what I'm seeing, that whole responsible investing, people are taking another look at it again.
Yeah, and I think with all of these different classes, education and really deep understanding of all the different factors of returns, liquidity, people really understanding what they're getting into when they're making these investment decisions is absolutely key. It's been interesting to watch, for me anyway, the sustainable investing, and coming from Australia, which is very focused on investing and sustainability, just the different dynamics in different countries is I found
I would
very
agree
interesting.
with
But
that.
good to hear that you're seeing that trend back in investing.
Even a year ago, we can't raise money with responsible investing, sustainable investing. It's just too hard. There's political backlash, there's greenwashing concerns, on and on. I think that's changing right now.
That's good to hear. Just changing sort of topics slightly, focusing on your business and what's really working well right now for FolioBeyond. Can you share some snippets for your organization, any client successes that you would like to share?
Yes. We've had some not only domestic wealth managers who have become interested in us, but we have had some international, that's Canadian people who have been interested in what we're doing. And we just recently saw an article written by a German financial journalist that came our way, and we never talked to them, but he discovered us, and he wrote a very good article, I thought, promoting RISR and what it can do. So RISR being the flagship is something that we have had to educate investors about, because it has something called negative duration. We buy the AAA or Ginnie, Fannie, Freddie interest-only pieces, and we mix those with treasuries to come about with a negative duration. Negative duration, in essence, means if interest rates go up, the price of our IOs goes up as well. Just the opposite. Everybody's buying the rents as they go up, prices go down in the bond world. So one of the reasons we've had the kind of returns we've had, approaching 17% average annualized return, is because of not only the rise in interest rate, but the diversification aspect. Security selection has been excellent from our portfolio managers, and people have seen that. Now, here's something very interesting that I never thought we'd see, at least so quickly. We had one investor who bought RISR because they looked at it as a responsible investing. Because if you look at what Ginnie Mae does, they do rural housing, they do veterans loans, and there's a whole host of concessions they give to borrowers that a bank wouldn't give them. So when you have the Ginnie Mae patina on it, it becomes a responsible investing, specifically with housing for people who can't afford it.
Yeah, that's fascinating.
Yeah, less money down. There's a whole host. I can go through it if you like at some point, but that's pretty detailed, is what it is. But in short, what we've seen, you were asking about snippets. One, a responsible investor looked at RISR and thought that this would fit his bill. And two, we just had some calls this morning with literally wealth advisors who were near panicked about their undiversified clients. We like to see that. And this is their answer. And it's not only diversification ETF, but it's also producing a 6% income.
Yeah, that's great. And was that through researching the product? Or
that's a very good question. How do they do it? We do send out emails. We do try to publish. We have a lot of white papers out there. You can look at each of our individual LinkedIn, and there's numerous stories that we give out there and assessments of what we think the market is doing. But I think we're also trying to get a little bit more advanced in people, when they look up rising rates or diversification, that we would come up first. Rise would come up. We're getting there where people are. A lot of advisors out there actually just Google something. I want a ETF that does this. That's their research. And more than a few times, I've had people call me. I just said, I just found your ETF, RISR. Can you tell me more about it? And we love those calls. We love to educate. We'll always take a call. And we're happy to talk to people. I think a lot of the wealth managers don't have time or want to. Some of the $10 billion fixed income people are not really they'll do their podcast and they'll throw it out into the ether world. But to actually have one-on-one talks with people, that we do that. We'll do that all day long. I think that's what differentiates a little bit.
Yeah, I think for advisors, with the alternative space as well as everything else, it is broad. So trying to educate yourself on every single thing is tough. So I think that's doing research and reaching out and having that one-on-one is going to get them there considerably faster. But yeah, that's interesting. There is so many different opportunities and different products that are available to people. And just knowing the detail, you really need to get into the detail of the products to know how it fits with.
No doubt about it. And we have analysis of that. If you would put RISR into your 60-40 or 60-30-10 or whatever portfolio you have, here's what it does for your Sharpe ratio. Here's what it does for return. Here's what it does for volatility. We do all those studies. Those are not difficult for us to do. But some of the implications about what you talked about earlier, as far as transitioning and changing, we don't have to deal with what advisors have to deal with. And I see this here a lot. The sons and daughters of aging parents, will these sons and daughters stay with their parents' advisor? That's an issue that advisors are looking at very carefully. Is there going to be a change in the younger generation with what I would call values-aligned investing that maybe my generation, not yours, but my generation wasn't as conscious of? And the other thing is, given the wealth growth out there, there's been family office growth. There's more family office popping up, reaching 30, 50, $100 million or more. And so they want dedicated services from these wealth advisors. And frankly, here's something else that's, I think, positive. Women as decision makers, that's increased exponentially, I've seen out there. And it's very nice to see, whether it's managing client money or managing ETFs or mutual funds or CEOs of companies. That's been a massive change over the last 10 years in an industry that wasn't the most friendly, frankly.
Oh, yeah. I mean, coming from a finance background and having spent in asset and wealth management, that's great to hear. It's quite often I've been in a room as the only female in the room.
And I shouldn't do this. I shouldn't do this. I always, when you look at a team, I'll take a look at the people in the firm. And I don't do this consciously, but unconsciously I say, oh my gosh, look at that. There's, 19 white men and one woman, and I say, how's that possible? Or you see a highly diverse group, which is very positive, which is very good as well. The studies have shown that diversity does increase profits. I'm not going to go through the details on that, but I've seen enough studies about that.
Yeah. And I have to say, I've been hugely supported by lots of different people in my career. And several people who've commented on that when I've been sitting in a room and been like, okay, we need to change this. As you've just reflected there, of actually looking up and going, okay, wait a minute, this doesn't feel like the right mix. But it's great. It's great to hear that. And it's great to feel it as well when that person.
So where we would fit in, again, within the fixed income world, there's all these mega ETFs, 10 billion, 5 billion, 15 billion. But we fit what I would call an ultra niche specialty. And we serve all of these wealth advisors because of our unique expertise. We brought an institutional product to the retail marketplace. Nobody has done this. The IO market has been around for decades and used by institutions for decades. And it's a new concept within the wealth management area, but I think it's taking hold.
Yeah, that's great too. Just thinking about some of the things that you're focusing on for the next 12 months or 6 months, and what are some of your the frustrations within the organization and some of the things that you really want to focus on? You mentioned there about Google search and popping up as an option, but there are other areas that are a focus for you?
Yeah. My concern is that despite the fact that the United States is dominant in the financial world, you're seeing that changing, and we're going to have to pivot at some point. We haven't done that. You're seeing more Asian dominance. You're seeing Middle East growth. You're seeing Africa emerge a little bit now. A statistic that I saw recently, like a couple of days ago, that wealthy Africans own 10% of the $2 trillion market held by the ultra high net worth individuals out there. That's a huge percentage, and we know nothing about it. And most people I talk to don't as well. Got to be aware of it. At some point, we're going to pivot. I don't know how we're going to do that, but that's something that we have to think of if you're looking down several years down the line. So we don't have international capabilities, or we don't have any global partners. So I think that's going to be requiring. And the big boys do. They have international capabilities and partnerships globally. I don't know how they're going to do it. They better have returns to back that up. And that's going to matter at some point as well. Those are some issues that we're looking at.
Yeah, that's fascinating. That's a really interesting stat on Africa.
Yeah, it's amazing.
There is a real global focus across many organizations. And I think that I kind of come back to education of getting your story out there and your people understanding, and then how does that fit together with everything else? But
exactly. You summarized it perfctly. Yes, getting our story out there, and how does it fit into your portfolio, your thinking. We found another channel for ourselves, which is the responsible investing. The world wants to diversify. So that's going to work for us. And we're specialists that very few people have, are the multi-decade experience in fixed income. When you look out there, how many people actually have been through a secular bear market, which we talked about at the beginning of this conversation? Very few people have been. People continue to think that interest rates are going to go down to 2-3% on the long end. And the Fed can cut rates all they want. It doesn't matter. For us, it doesn't matter because the steepening yield curve only helps, our product.
I've spoken to quite a few people on this podcast, and everybody has a very similar viewpoint that interest rates are not going to go back to where they were. I mean, I remember my parents talking about interest rates being at, 12, 14% during their sort of early careers. And at the time, when I was like, I can't comprehend that. But
they were originating mortgages at 16%. They were originating mortgages at 16%. Now, who's going to have a 60% mortgage? Either you want the massive tax deduction that you're going to be getting at that time when those rates are high, you could deduct mostly everything, or you're in prison and don't have a chance to refinance. It was very rare to see how many that people didn't keep those. Nobody kept those mortgages, but it was an interesting period of time that Volcker initiated, if you will.
Yeah. And when you think of the areas that you want to focus on, are there any particular sort of stats or internal measurements that you use and you say, look, we're here today, we want to be here?
We thought from the very beginning that given the income, diversification, reduced volatility, all of these, it almost sounds too good to be true, and we get that a lot. We thought that we'd be $1 billion as far as a ETF. And I think there's a chance of us getting there, especially in the next 2 years. So that's one of the things that we had an expectation that we'd get up much higher than $200 million. But that's, from what I understand, that's still more AUM than like 70 or 80% of the fixed income ETFs out there, which is amazing. We continue to believe that this product is going to be very helpful for the advisor. We're not resisting technology either, so we're constantly trying to embrace it.
And what does that mean for you as an organization?
For us, it means there's a lot of outdated models out there that have to be reconfigured with AI, I think. There's a lot of, I think the wealth management industry is unrecognizable in the next 2 years, 3 years, 5 years from what it was even in 2005. It's very different than it was. And I think technology is a big part of it. But again, as we mentioned earlier, that personal touch is not going away, probably ever. So unless we become robots, I don't know, it could be.
Hopefully not. Yeah, I think I think about it as a massive enabler for people.
I do too.
Just having information to hand as you need it. But then I sort of talk about that human in the loop. You're always going to have believe, especially particularly with wealth. You want to look someone in the eye and have that conversation about what you're investing in that conversation.
You do. Absolutely. At the same time, as a small example, I don't need to have a driver in the car when I'm going someplace. I was in San Francisco last week. I only took Waymos. So I'm not sure if you've ever been in a Waymo.
I've been in one. Yeah, last time I was in San Fran, I was curious.
That's all they did was took Waymos. In fact, I took them just for a joyride a couple of times.
I did exactly the same thing.
And I love them. I think that's the future. At some point, New York's going to have them. I guess LA has them, San Francisco has them, but you can't go to the airport with a Waymo in San Francisco. I think that's coming. They won't take you to the airport. It's not highway driving yet.
Well, I thought about it from that perspective. Yeah. I've covered all the areas I was going to cover. Is there anything else that you would like to share?
Yeah, I think we did okay. I think, we're a small boutique. We're in the fixed income world. Most of the world thinks equities. And I think they're starting to change right now. And I think there's a cautiousness out there that is unprecedented, at least for the last 5 or 6 or 7 years. I haven't seen this kind of caution that's starting to come into play, which means the very old word that's been around forever, and we've talked about it here, diversification, is going to be key. But how do you diversify? When you diversify, what is the result of that? What happens to your Sharpe ratio? What happens to your volatility? What happens? Does gold do that? Well, gold doesn't produce any income. You want some diversification that produces income as well. There's a whole host of alternatives that are probably not good diversifiers out there as well. We can talk about that another time, but we believe that you need income, you need diversification. You can't be correlated to fixed income or equities, and you got to be able to reduce volatility. And I think that's what people will need as they get off the euphoria of being geniuses and showing all the returns they've made in their equity portfolio. I mean, I'm golfing with a guy who was a janitor all his life, and he told me, I can't believe it's like 5 months ago, he goes, I can't believe my portfolio went up $75,000 a month. I said, okay. And I said, what are you involved in? Oh, my guy's got me in all the tech stocks. Yeah. Okay.
Yeah. I suppose time will tell. See where this all goes. But diversification is key. I keep telling everyone that. I'm like, you've got to really be mindful of all the different aspects and absolutely get advice. Yeah. This has been a fascinating conversation.
Yeah, a lot. I don't think we've talked about credit risk either. No, I think the credit spreads have been extremely tight for a long time. And I think at some point, I think it's starting to change dramatically. Mm-hmm. So that's something you should look at, the actual credit of what you're buying. Private equity has had that issue. They're marking their portfolios, maybe not the most diligent way, it seems, but I think you might have a little bit of problem in the private equity world at some point. So if not now already. So the credit issue is going to be key going forward as well.
Yeah, and that's a global perspective, I think. Yeah, there's been sort of consistency or for a longish period of time, and things are just starting to change, and it's how quickly and how much it'd be interesting to see how that develops. I mean, I hear a lot of people are actually saying, I'm coming out of this, I'm coming out of that. I want to just hold cash, which is an approach, but there's definitely a lot of cautiousness.
That's good. You're seeing supply side inflation through tariffs. Those are not going to go away no matter what he does with coffee or whatever. You're going to see demand side stimulus. Deficits are not going to go away. And then you have government chaos that seems to be shutdowns, disrupting commerce. And all that to me points to stagflation. That could be a problem. We don't have it yet. People have been talking about it ad nauseum. But I think at some point we will reach that stagflation period.
Yeah, there's been a lot of chaos across different aspects that are causing just general disruption and uncertainty. If people want to know more about you, the team, the products, how would they go about reaching out and connecting?
FolioBeyond.com has everything, including our writings. You can go to the FolioBeyond Partners LinkedIn. We don't put stuff on LinkedIn that is personal. It's all related to what we think the economies are going to do, what certain securities might do. So our LinkedIn is very deep as well. Personally, both my partners and myself. And we have a monthly commentary that comes out, as well as white papers, maybe 2 or 3, 4 times a month.
Is that coming out through LinkedIn or?
No, we're sending it out through our email contacts. I'll put you on the email list.
Oh, that'd be awesome. Yeah, okay. Well, that gives people a way to reach out and connect. Well, thank you very much. This has been absolutely fantastic. I love understanding more about the products, and thank you for adding me to your email list. I will reach out and ask more questions, and I'll share with the team, the internal team as well, and see if,
Thank you.
Awesome. Thanks for listening. I thoroughly enjoyed that conversation. If you enjoyed this episode of the Wealthmind Podcast, we'd love for you to subscribe, rate, give us a review, or comment if you'd like to dig deeper into this topic. That's all for this episode. Thanks for listening, and see you next time.